What's up, everybody? Welcome back to another video. My wife and I just got back from vacation. As you can tell, I got a little too much sun. But while we were gone, CPI data was released and we hit a 41-year inflation high. So let's dive into the report and see what we are in for. All right, so first let's start, let's kind of zoom in over here. Hopefully you can still see this. But so this is from the Bureau of Labor Statistics, the All Items Index, which is this category right here, which is basically just all of the categories from a consumer spending perspective, increased 9.1% for the 12 months ending June, which is the largest 12-month increase since the period ending November 1981. Gosh. So that is this category right here. Let's see, right there. So some of the other, actually, let's jump over to this tab right here. This is a little bit more detailed than that other one. Let's see if we zoom in here a little bit. Food at home increased 10.4%. And then food away from home right here increased 7.7% from June 2021 to June 2022. See, energy. So overall energy, 41.6. Energy, let's skip down. So fuel, oil, 98.5%. That's not gas. That's more like crude oil. But you've got motor fuel here. At 60.2%. So it is 60% more expensive at the fuel pumps today than it was June of last year. And that's another important point is this, we're a month behind. So this data is looking at the previous month. So even though we're in July, we have to look at June data because that's when the month finishes. So this is food and energy right here, but food and energy are so volatile that it can sometimes be better to just look at your core indicators, which would be everything else less food and energy. So if you take out food and energy, we had a 5.9% inflation increase, which is still high. But you can look at some of these categories. So like new and used vehicles. Let's see, we're looking at 11.4% for new vehicles. That could partly be to supply chain issues with, the chips that you have to put in the cars. So that could be part of it. 7.1% increase for used cars and trucks. And then this one's actually really interesting. So shelter, if we go all the way over, if you look at shelter, 5.6%. That when you think of like how much housing has increased recently, 5.6% seems way too low. But this index and this measurement does not count home price increases. The purpose of this report is to just look at our consumer spending, almost on like a daily, regular basis, what we're spending as an economy. Real estate is considered an investment and therefore not counted in this report. The other two here are rent of primary residence, so rent is counted, and then owner's equivalent of residences. This is, for example, if we were to rent our house, how much would that rent for? And that has increased 5.5% since June of last year. So yeah, really interesting. It would be, if house prices were included in this report, gosh, like inflation would be off the charts. So probably a good thing it's not in here. That would freak a lot of people out. One other thing, and you probably can't see it behind my face, this last line down here is airline fares, and airline fares has increased 34.1%. So it's a lot more expensive to travel this year than it was last year. But really interesting report. I guess the next question is, okay, what does this mean from, an investment standpoint? How are we going to spend our money going forward to make the best financial decisions? And I think the biggest thing that's going to happen is the Fed is going to look at a 9.1% inflation and say, we're not doing enough. One of the best tools that the Fed has to control inflation is interest rates. And we already had a huge hike last month. And I imagine that the Fed is going to look at this and say, we need to do another interest rate hike. So I imagine that's coming in the future. One thing I'm worried about, though, is, like I said before, this report is 1 month behind schedule. And if we are making decisions based on last month, it doesn't take into account the current state of the economy right now. We've already seen a very significant slowdown because of the last interest rate hike, but that slowdown is not reflected in this data. So if my fear would be is that the Fed overcorrects and puts us into a potentially more severe recession / housing market than we actually need. Because with the last interest rate hike, we're already seeing that slowdown. So if the Fed increases it even more, we're going to have even a more significant slowdown, and we might end up overcorrecting. So then that begs the question, is now a good time to buy a home, or should we wait until, house prices drop potentially even more and then look at investment properties? It's tough because the house might be cheaper, but the debt to afford that house is a lot more expensive. The last interest rate hike had about a $40,000 effect on purchasing power. That's very significant. So if you think that house prices are going to fall more than 40%, then yeah, it might be a good idea to wait. But only time will tell, I think, what will really happen and see how, once we see how the market responds to this report. Ultimately, I think real estate has always been a great investment. I think at this point, if you are choosing to invest, you know that it's a little bit higher risk, and you might have to be in the position to wait out a market dip before it comes back up. Fascinating times that we live in right now. But it's very important to watch this stuff because this is opportunity. There were so many people that got their success from the 2008 market crash. And I'm not saying we're heading into another 2008, but I think we are heading into another season of opportunity where there will be lots of chances to capitalize on a dip in the market. So thank you guys for watching. Hope this added some value, and I will see you next time.